Good day and welcome to another episode of SkyTail Insights. Today we're very excited to talk about M&A in healthcare in 2026. Joining me is Camilo Horvilleur, Managing Director at H.I.G Capital, where he helps lead the firm's small cap and growth buyout strategy and its U.S. healthcare efforts. H.I.G is a highly active global private equity firm in the middle market, and Camilo spends his time investing across healthcare and partnering closely with management teams to grow and scale their businesses. He has a true front row seat to what's actually happening in the market today. Camilo, really appreciate your joining us.
Ben, thank you for having me on your podcast. Much appreciated.
Yeah, I'm really looking forward to this one. I saw you in very early January, and thinking back to then, we were all, I'm sure, sharing our thoughts on 26. So now, skip over. We're not quite middle of the year, but we're getting there. So, maybe can you tell us, coming into 26, what were your expectations in healthcare specifically? And then how has that reality, come to fruition? How's it compared to what you thought about coming into the year?
No, it's a great question. And just to give you a perspective and kind of you mentioned being at the front seat of kind of some of these deal, healthcare kind of deal dynamics. H.I.G, we've been in business for 33 years. We started out as a small firm in Miami, which would focus on private equity investments, typically founder-owned businesses that were kind of smaller, kind of small to mid-size. And we've grown into being now kind of a national, if not global firm, doing the same kinds of investments, which are really partnering with founders in what we call the small cap or lower middle market or middle market. But our bread and butter is really working with founder-owned companies and helping them grow. And so, small firm back then, 33 years ago, now 1,000 employees. We manage as a firm $75 billion of equity capital. So we're very fortunate to have real scale and see lots of opportunities. So, we're very proud of having a big healthcare vertical, which I know is obviously SkyTail's bread and butter. We've got about 30 people in the healthcare team. We have about 30 different companies in our portfolio. They really span kind of the gamut between healthcare services, whether it be retail healthcare, like many companies that you guys connect with, to things such as healthcare technology, things like pharma. So we really do a bit of everything, always with the idea of really partnering with the great management teams, with great founders, and really helping them scale. All right, so the question is, 26, what do we expect? Well, coming out of 21, which was a huge M&A year, we had a few years that were a little choppy. And, every year we see each other in January. There's this big healthcare conference in San Francisco called the JP Morgan Conference. And all the investment bankers and industry participants said, well, 26 is going to be the big year. It's going to be back to the good times. And the gates are going to come open and you're going to see all the backlog of deals. And now we're, I guess, 5 months into it. What's happened? Well, look, the M&A market, I think, is healthy and it's certainly open. And people were hoping for that COVID hangover to dissipate. People were hoping for this valuation reset to happen. Sellers kind of come back to earth a little bit. People aren't paying as much. But what have we seen? It's been a healthy M&A market, so good deals are getting done. There are people more realistic on buy side and sell side, but the floodgates really have not opened. And I think part of what's happened is there's still a bit of a mismatch between valuations. And number two, a couple little things, such as AI and concern about AI impact on certain businesses. And there's a little thing called a war in geopolitics in the Middle East. And so I think that has created some noise, but deals are getting done. The M&A market is open and available, and great companies are being sold every day, and even companies that need a little help are getting sold every day. So I think still it's robust, but not as people expected it to be.
Yeah, I think that's a great summary. A little bit maybe valuation gap and mixed in with a couple of little things, as you put it, that cause uncertainty in the markets, which is never ideal. So, that's a great macro view. Maybe you specifically are at H.I.G. What are you seeing specifically in terms of deal activity, valuations, and how are you talking about overall market sentiment?
Look, the neat part about being private equity investor that focuses on really founder-owned companies called lower middle market companies. That's especially where I've spent my time in my 20 years at H.I.G. is we get to be both a buyer, a board member. We don't run companies. We support our portfolio management teams, and then we sell companies. So at any given year, we're buying companies, certainly overseeing them, but certainly selling them too. And here's, I think the question is kind of what am I seeing in the market and what are we kind of seeing at H.I.G. is, it's not easy to sell businesses, right? Because people, particularly in healthcare, are picky. A lot of people, healthcare used to be this very defensive sector, right? Healthcare only grew as a percent of GDP, became 20% of GDP, more or less. Kind of people loved it for being non-cyclical, non-seasonal, very defensive. And then COVID happened. And then in COVID, there's a real dislocation in really all parts of healthcare. Everything from, of course, the pandemic itself, and obviously its impact on people's health, and unfortunately people died and got sick, but also its kind of trickle-down effect on the system, right? Clinicians, reimbursement, infrastructure, pharma, regulation, so it had all kind of effects. It really created this long hangover in the sector. So what are we seeing is we and other people are really trying to pick their spots in healthcare, which is where can you find assets that are less impacted by that noise? Where do you have, for example, the ability to control your own destiny? So for example, if you're reimbursed by the government, maybe that's a little bit out of your control. Do you have a company that has pricing power? Do you have a company where you can grow and there's an organic growth story? Situations where you have that, what I call factors in your control, certainly, and particularly ones that have operated and executed well the last several years, are selling for a premium. And those that have more limited ability to control their own destiny and perhaps are impacted by AI directly are ones that are being a little tougher to exit and or buy.
That's great. And then, you mentioned the significant percentage of GDP that healthcare makes up. So in other words, we're speaking here very broadly. Are you seeing capital flow into any specific subsectors within healthcare? Or conversely, are you seeing or hearing of folks maybe staying away from certain subsectors? What do you like or dislike right now within healthcare?
Look, the beauty of healthcare is exactly what you said, Ben, which is it is really broad, right? It really spans the gamut from services, consumer, B2B, pharma, healthcare IT, med tech, right? A lot of healthcare touches of a lot of space. And what's neat about it is, we, the way we go to market is we are specialists in investing in kind of small to mid-sized companies, but we're also sector specialists. So at H.I.G, everyone who is a director or principal level and above is a specialist in one of our 6 core verticals, of which healthcare is our biggest vertical and very biasedly one of our best. But what I would tell you is, at any given point in time, there are subsectors of interest for us in the market, and it has to do with some of these fundamentals that I mentioned earlier around supply side, buy side. But for example, pharma's been, soft in the last number of years for a number of reasons, impacts of GLP, government funding, et cetera. Within the services side, where I know where you guys spend a lot of time and your kind of clients and people who you speak with, it's been tough, right? So obviously things like aesthetics, med spas did really, really well coming out of COVID for a variety of factors, whether it be, consumer spending, whether it be people staring at themselves on the Zoom, social media and otherwise. And your clients know better than I do. And then a lot of retail health had a tough couple of years. It's tough to find clinicians, tough to keep staff, inflation, right? So it all hurt. So demand compressed at the same time. They got more expensive to operate your businesses. And it really kind of revealed that some businesses and operators and practices had a good business and some had more challenged businesses. So as a result, to your question about what has been tougher, certain provider businesses have been tougher because there's been more of a mixed performance in the sector. And then when you combine that with certain provider businesses are reimbursed by governments or big insurance companies, they might not have been able to, get reimbursement increases at the same rate of your cost increase, also pressuring your bottom line. So that's a little bit of what we're seeing in terms of some of the factors at play. I don't know if that answers your question, but that's what we've seen.
No, that's very helpful. Are there any, whether it's thematic or specific subsectors, where you're seeing a gain of momentum? You mentioned a lot of the changes that happened post COVID. You brought up AI, a few other things as well. Are there any that are well positioned for today and go forward that you're keeping your eye on, maybe?
Look, that's a great question. Look, as a private equity investor, we're by definition, we make investments in typically private companies, and we're there to help, work side by side with the owners and the managers to help build that business. And we typically are investors for, call it, 5 years on average. And so we're not thinking about what's going to be a good trend for a quarter or two or this year or next year. It's really about business building. It's really about business building and scalability. So we're not thinking so much about what is a good trend this year. It's much more what are the good fundamentals. And in healthcare, you've got a number of really good fundamentals. The U.S. Aging population, right? People want to age at home, as a for example, right? Novel drugs, right? GLPs, et cetera. I know you spend a lot of time in aesthetics, right? Like, aesthetics and cosmetics, right? And so a lot of those are what I call secular factors that are multi-year. So we definitely like what I call situations where there's a good fundamental backdrop, such as the ones we've discussed. Another one of those, for example, that we spent time in and have a thesis in is fertility. Why? Again, secular factors, right? Fertility, people just, as a society are having kids later in life, right? The advent and the rise of same-sex marriages, right? And so all those factors create a dynamic where there are, family formulation is happening later in life. As a result, some folks need, assistance in that process. And the fertility sector has been a beneficiary, and I think that's one's going to continue in the future. For example, we talked about aesthetics as well as, for example, one we like a lot. And at H.I.G, we've had a number of subsectors like that. We continue to like things in pharma, continue to like certain technology plays. But really, I can go through every subsector we like, Ben, but it's real simple. We at H.I.G get excited about partnering with the right teams, because even in it, healthcare is so big, Ben. It's so big. Again, about a fifth of our GDP, that we like to find, great operators who, whether it be a faster growing, subsector or less rapidly growing one, that they have found kind of a good solution, a good mousetrap, just execute day in, day out. And that for us gets us really excited. And that's where we want to spend time partnering with people.
As you were talking there at the end, it's really impressive how the firm, in its history, the DNA still sounds like it's there. You mentioned it started as a small firm, obviously not small anymore. I think you said 75 billion AUM, and still the DNA is still there. So maybe let's talk about some of that a little bit. You talk about partnering with great operators, great business owners and founders. How would you define that? When you say that, what comes to your mind? What's a high quality healthcare asset? And maybe has that changed since 21?
Look, it's a really good question. It's a really good question, and it's a really good point. Most people know what great looks like when you see it. But I want to kind of clarify what I said in terms of both our investment strategy and what folks like us are looking for. Then we're not just looking for the fully optimized company or team firing in all cylinders. That's great. Who doesn't like that as an investor, right? That's like set it and forget it type investing. That's fantastic, right? And there are a lot of good investors that really want that. The highest quality growth at any price type investors. That's great. I'll say, you said, you alluded to our original DNA. I want to go back to what, the words that I used earlier, which are business building, right? We actually get really excited when you have a talented entrepreneur, a talented management team, has ideas, and they come to you and say, I'm not just looking to sell my business, but I've got all these things that I've wanted to do, but I just haven't gotten to them yet. And typically it's a combination of, maybe it's a lack of financial capital. I wanted to make certain investments in my physical plant and marketing. I wanted to buy this business on the street. I want to buy my competitor, whatever it might be. We haven't, either we don't know how to do it, or we don't have the capital to do it. And or really oftentimes is, hey, we're really good at doing X, Y, and Z, but we've never, upgraded our technology. We've never upgraded kind of our ERP system, things like that. So can you help me do that? That's when we get excited, because we're fundamentally the kind of firm that we love to roll up our sleeves. We're scrappy guys, and we want to partner the management teams to do that business building. And that's when we get really excited. So that's a little bit of the H.I.G DNA. But to answer your question around then what makes for a great healthcare asset, I mean, number one, it has to start with, that value proposition, which another way which is a fancy way of saying kind of that it's got to be the right thing for the patient or the consumer, right? It's got to work for the system. You have to charge a fair price for that, whether it be a government, whether it be a commercial payer or a consumer. And the business obviously has to have kind of good economic fundamentals to be viable and grow and scalability. So we look for those situations, particularly in healthcare, where you have that triple aim are kind of really well aligned. And where a lot of people have made mistakes is one of those is misaligned, right? Not providing good clinical care, but charging a high price. That's not a formula for long-term viability, for example.
Yeah. So whenever you do find an asset that you really like, you think it has those things, talk to me about the diligence process a bit. More specifically, I know here at our firm, we've talked about the last couple of years, it seems to be a little bit more stringent as we get into
Sure.
diligence. I'm curious whether you have seen the same thing as you go through it as well. And, are there any focus areas? What has changed, if anything? What are you seeing right now as you diligence companies? And you also sell them. So curious how you see it.
I alluded to this COVID hangover. I'll blame it on COVID again. So you're right. Look, the due diligence process, which is what guys like us do when we go evaluate a new investment, whether it be an equity investment or even, some folks are in debt investments. You understand the business, understand the fundamentals, understand financial due diligence, compliance, IT, all that good stuff. That's always been part of the way this industry worked. Then what happened is, COVID was an interesting time. COVID obviously was profound. 2020, obviously the unknown, and then coming out of that unknown and the reopening, a lot of deals got done. And a lot of deals got done at a time where people were still kind of working from home, or kind of the economy wasn't quite open. Capital was flowing very freely. We had near zero interest rates. A lot of private capital had been raised also. And I hate to say it, but I think a lot of people, number one, I think industries in general might have taken some shortcuts because for a lot of reasons, people were just busy and had a lot on their plate. And number two, I'll say it again, it was kind of a free money almost environment, i.e. very low to no interest, very low interest rates. And so what happened? Not the most stringent due diligence for a number of reasons, people being busy, structural issues, people working from home, et cetera. I'm not saying that was the direct result, but all that contributed. And number two, people paid higher prices. Why? Because you can when capital is very cheap. And so what happened is a lot of deals got done in that 21 period at high prices. And in some cases, diligence was not perceived as thorough as it could have been. And then on top of that, and again, I'm talking about healthcare specifically, I'll say it again, you had that hangover effect, right? If you're a provider business, it got really hard to find good clinicians, right? burnt out of COVID, and no one blames them, right? It was tough. If you could retain folks, cost was very high. So you had labor cost inflation, and then you had kind of patient issues getting back to her. So it just got hard to do business, and as a result, performance for the sectors, particularly in healthcare services, has been really choppy, for lack of better words, last 3, 4, 5 years. So as a result, buyers are all very much on edge, and they're all really cautious around making sure they really understand what they're getting, right? And so there's a little bit of, hey, we're going back to the basics of understanding the industry, the company, the financials, all those factors to make sure that they kind of know what they're getting. It's not all bad. It's not all bad. So if you're the seller, it's not all bad. Our philosophy, for example, is we don't apologize for being thorough due diligence. We want to understand what we're buying, but it really is hopefully for a good reason, which is, yes, we have a fiduciary to our investors who are things like pensions and endowments, universities. But number two, we really want to be a good partner. We want to be a value-added board member and to support the management teams after we make the investment. And the only way to do that is you really have to understand that business during that due diligence process. And so for us, it's really part of that. There's a reason why we are detailed. So I think the industry as a whole has gotten more stringent. But I also think as a function of, for a couple of years, it might have been looser, and that probably was not the right baseline.
Yes. Yeah, I think you're absolutely right. Going back to 21, 22, that did seem like a bit of a magical time, at least from a transactions perspective. You alluded to a lot of it, right? Low cost of capital, near record or record, kind of reaching dry powder. So a lot of money to invest and needing to put money to work. So, and then you have today, which is quite a bit different. So if I am a founder and I'm listening to this and I'm thinking, okay, I think I understand what Camilo, what H.I.G like, and I'm trying to figure out how to build my business, maybe how to position it over the next 1-3 years. What are like Camilo's top, 3 to 5 things? What do you think?
In terms of what I would do if I was a founder, to think about kind of
yeah, and then before I go out to market, what should I be focusing on to make sure I'm attractive to you?
I've got a partner who has this saying that I adopted or I stole from him. I like it, which is, if you don't run your business like you're gonna own it and run it for 20 years, 10 years, then you're gonna own it and run it for 20 years and you won't be able to sell it. What I mean by that is, if you're the kind of team or owner that's taking shortcuts, it's really hard for a buyer to invest in the business. And by the way, shortcuts doesn't mean, hey, I haven't quite invested in my IT infrastructure the way I would like. It doesn't mean I've got 2 locations or 10 and I want to get to 20. That doesn't mean that. But I'm talking about, shortcuts in terms of, just not putting in the right foundation for your company of the size that you are today. If you don't have, for example, the right, very basic, right, compliance, obviously in the bedrock what we do in healthcare, right, compliance framework, people, process and procedures, financial reporting, just being able to understand what do the books tell you, right? Are you able to understand profitability and cash flow of the business? Basic IT, right? Understanding, can you scale this business, right? So if I were a founder, I would be thoughtful around putting in these elements in your business. So, and again, appropriate for where you are today, perhaps for where you want to be, and not taking too many shortcuts. Again, I'll give you the for example, shortcuts with compliance and healthcare is a really bad idea for a whole host of reasons, both from an integrity, ethically, and from a standpoint of just that's not a good recipe for being compliant with big payers, for example, or consumers. So that's something I would never do. So it's really about being as buttoned up as you can, and I think also just being, being thoughtful around, what do folks like us need to see? Clean financials, right?
Mm-hmm.
Some kind of ability to report out of the business, ability to report out on operating stats, financial stats, understanding things like, are you buttoned up from an insurance perspective, things like that. Labor. Does that make sense?
Oh, complete sense. Yeah, I think that's very helpful. And it's interesting. We have a similar saying. We talk to whether it's our
Please.
clients or other founder owners, they ask us this question, as you can probably imagine, quite frequently. And we say, run your business as if you're never going to sell it. The other thing that we say, some of the things you said there at the end, right? Some of the things that we know that you, for example, like to see: clean financials, data. By the way, ideally, you're reviewing it. All of
Yep.
these things that you said, if you put those in place, whether you sell or not, you're adding value to your business, whether it's at the
100%.
point of sale or if you keep it forever, ideally it's cash flowing a little bit better for you. So either way, these are great things to keep in place. So, thanks for sharing that, Camilo.
What have you seen? Well, out of curiosity, what do you see as kind of the key challenge for founders when they're trying to, consider an investment for a firm like ours, aside from just the financial, kind of hygiene, if you will?
Yeah, I think, some of the challenges that we see, or, put the other way, when we see it done right, we know it's going to be very competitive in an exciting way. Is, number one, we say the same thing: financials, KPIs, oftentimes any sort of, whether it's bonus model or comp model, we like to remind our clients, whatever you put there,
Sure.
like, show me the incentive and I'll show you the outcome, right? I think Charlie Munger
Yep.
says that, or said that rather. I think that's one. And then beyond that, you mentioned earlier, Camilo, how difficult it was to find clinicians coming out of COVID. A lot of the subsectors we're in, we're still seeing that. So number
Sure.
two, we're looking at retention. And by that, we mean employee retention in
Hmm.
addition to patient retention. Those are absolutely key. So we talk about that a lot where there are multi-site. I don't know if you hear this, but we hear a lot like, oh, I have 10 locations. It's like, great. How's it performing? Right. And
Yeah.
then maybe you only have 2, 3 good performers. So we like to remind folks, hey, it's not necessarily only about adding locations. Make sure that especially your first 2 or 3 are as best as you can buttoned up, because that's going to be your model for go forward. And you want to have an actual business versus a hodgepodge of practices. And especially as the founder, you can't be in location 6 like you were in location 2.
Mhm.
So you have to really figure out a way to systematize and make sure that make sure that your company becomes a vision led, not a founder led organization.
Mm.
Because then what you're doing is they're able to go to you, for example, and show, hey, I have this secret sauce. I have a way for repeatability if you do invest in my business. So those are some high level things that we allow folks to really focus on. But at the end of the day, I always like to say, really figure out your vision and what the DNA of your
Hmm.
firm is going to be, one. And then two, everything you do, start thinking, is this scalable? Can I scale it?
Hmm.
So yeah, those are some of the things that we see.
I love that you said that. And, obviously we're just talking about high level basics around financial reporting and all that good stuff. But once you get to kind of the phase two of things, um, what I love about our business, and again, way back when I was a public market investor, what I love about the private equity business, particularly in kind of small cap businesses, is it's all a people business, Ben. It's all people.
Yes.
It's people. It's a good investment. You can't have a good investment if it's a bad partnership, right? Or it's very tough to do that, right? And the best companies have the right culture and the right kind of, to your point about the right philosophy of growth. So, we really try to pick up on that very early in our investment, which is when you spend time, you walk around. So, for example, if the business is making it up a call center, well,
Hmm.
just not making it up. If we would have looked at a call center 10 years ago, you walk around and you look at people's faces, people happy to be there. Do they answer their phone call with a smile on their face or not, right? The same thing, you mentioned a retail health co-location. Is it inviting when you walk in, right? Are the patients treated well? And it really is that culture. top to bottom is so important, because I bet if you have a good culture, if I bet, the people side of the business is dialed in, you're going to have a good company, and the results will just follow that process. Again, it's the hard stuff, but as we know, these intangibles are so incredibly important. And so that investing, that founder or that operator that spends time in their culture, spends time with their people, develop good people, hire good people, train them, that really, that pays off in spades. And we see it. Guys like us, gals like us, we see that. We see that.
Oh yeah, I could not agree more. You mentioned the intangibles, and it sounds a little bit out there sometimes, but you said it earlier as well. You know what good looks like. So when you do have a
Yeah.
company that has those things, it just clicks. This is a good business, and you know almost right away.
Sure. Sure. One more thing that you reminded me of as you were saying this, which is what else can you do to prepare for a sale or potential partnership? I think and this is perhaps where you spend a lot of time on this too, which is I think that owner needs to go through that soul searching, cathartic process before they get to folks like us, which is, what are you looking for? Right? If you're looking to, sell your business and, leave the next day, that's one thing. It's okay. It's your business, your prerogative, right? But that's one step. Number two, do you want to sell a portion of your business, but you want a passive partner? It's okay. That's what you want. Do you want a more active, partner, one that's going to allow you to, for example, effectuate a succession plan? For example, these are all this shape. And so I do think there's an element of that owner, kind of determining what is their transaction objective, liquidity up front, liquidity down the road. A lot of people that we partner with, for example, they want to take some chips off the table day one, but they're really excited about, with partnering with a firm like ours, that we have a very big operating partner team, IT specialist, AI specialist, digital marketing specialist. They say, boy, I want to do all those things. If I do that, that second bite of the apple will be really, fruitful, juicy, for lack of better words. And so that's a for example. So I think just that owner understanding what they're looking for, and then you jointly flush out that vision, that strategy, and that operating plan. I think those are some good elements to hopefully foster a good partnership. And then once you're rowing in the same direction, you can hopefully make some progress towards that value creation plan, or the VCP, for example, as we talk about it, to kind of get where you want to get.
I'm glad you said that. And you're right. We deal with that as well. It's one of our first conversations of why. Why are you considering this in your mind?
Mm-hmm.
What does that look like? And then we talk through, what it typically looks like for our clients. That alignment is key. As you know, Camilo, dealing with, working with founder owners, when you sell your baby, it's an emotional roller coaster. So you need to be sure that you're completely aligned as to your why before you go through the process. I'm glad you mentioned that. That's a conversation we have with every client and lead personally that we speak to, is to, really figure out why you're doing this and what your post-close life looks like in your mind.
Right. I think that alignment of incentives and just kind of openness is really necessary.
Yeah. Now, speaking of the future, I'm going to ask you a crystal ball question. We talked about where the market is today. What do you see if you had a crystal ball? You don't have to be fully right, although I'll come back to this and call you maybe in a year and see if you were or not. What do you see for the rest of 26? You can even go into 27 and beyond if you like, but what do you see here in the future?
As it relates to healthcare investing, kind of in this part of the market, or broadly speaking, what's your kind of?
Yeah, it can be either. Maybe some of it ties together, but maybe how the broader market's going to do. How does it affect healthcare? And certainly, yeah, I would love your thoughts on, in our space, healthcare, how you see it.
Yeah, I certainly do not have a crystal ball, but here's what I see, which is, look, the M&A markets, I think they are, I kind of use the word balanced, which is I wouldn't call it a buyer's market. I wouldn't call it a seller's market, but it really is barbelled, for lack of better words, which are those assets that don't have, these quote unquote obvious issues, let's say, is AI going to potentially disrupt that business? Uh, Things like that, I think are really, getting a lot of interest, right? And so you've seen this market where these trophy assets have traded for, frankly, above market prices, for lack of better words, because of, a lot of capital is chasing few deals. Secondly, I think there's a real premium on talent. And so companies that are well run, that, for example, if you are a retail health space and you've got great same store sales metrics and unit economics, and you mentioned kind of the having a few locations and having 10 locations, if you have a proven ability to manage that, also very much in demand. So I don't think that's going to change. I think they're still going to have this barbelled approach. What I do see happening in the M&A market, though, is I'll go back to this period where there was a bit of euphoria 5 years ago in 2021. There's a lot of assets that are people's portfolios, and some perform well, some have not, and some are kind of in the middle. I think folks have been reticent to sell those assets for a lot of reasons, and that maybe they paid a high price, maybe companies aren't quite optimized yet. But I think at some point there is kind of a natural point of the cycle when owners of these businesses have to sell, provide liquidity to the limited partners of the private equity firms. So I think that will likely happen probably the next year or two. So I think you're going to see at some point, more and more assets coming to market that aren't these obvious trophy assets, if you will. And I think it's going to be an environment to where I think the M&A markets will likely be busier from that perspective. I think financing, continues to be, I'd say robust for certain businesses. There's still a lot of capital out there, but again, if it has some of these kind of concerns, I think it's probably tougher to get financing. And so that's what I see. Fairly balanced market. I don't think it's going to be crazy. I think GDP, I think it's constructive enough, meaning if you have a well-run business, the beauty of being a mid-sized company, smaller company, is the economy can be a little bit better, a little bit worse, but if you run the right business, I think you'll do well in any environment. And so that's a little bit what I'm seeing. I think it's, modern M&A market. Expect to see probably more activity. That's my guess. And from a valuation perspective, I think there's going to be a real range in terms of kind of what it looks like based on the factors we discussed.
Well, you're one of the sharpest guys I know, so I'm guessing that most or all of these are going to happen. Really appreciate that answer. I really like the term balanced market. I think that's a perfect way to put it. And we could do a whole other session on this one, and I'm glad you touched on it. I might have to ask you next time we're together. But yeah, a lot of these assets, you continue to see it in the news, that are kind of near or at their hold periods and haven't yet traded. I've been curious on a personal level as to, when that might happen and what that might look like. It'll be interesting to see. Camilo, is there anything that I failed to touch on that you think I should have brought up?
No, look, I think that, I think you guys do, I know you guys do great work for your clients and helping them think through these very issues around how to what I call improve the foundation of the business, become kind of better run business, and ultimately helping them if they think about exiting a business. And it's never too early to start thinking about how to improve your company and how to exit your business. So I think these are the right topics. And look, the fun part of our business is being an entrepreneur, right? And so we really enjoy meeting the owners, the operators that really started from small, or kind of their small businesses. And I always say that when you walk into like a nice conference room or a nice office, that's 10 years later. Mm-hmm. That's 5 years later. Much like SkyTail, that's it's years later after you now have lots of employees and really have some nice scale. But it all started with a couple people and a risk and and some sleepless nights. And so it's really fun for us to meet the entrepreneur, and we really kind of appreciate the work they do, and it's really fun to do our job, which is to support them as they think about the next chapter. So thank you for having me today and comparing some notes.
Yes, thank you as well, Camilo. And I think that's such a great reminder, the privilege of working with founder owners. And, I always like to remind them that if you look at the American economy, they're kind of the backbone of it, kind of small to medium size businesses. I think that's such a good reminder. Thank you. So, Camilo, as you know, we have great respect for you, of course, the entire market, and we certainly do have great respect for H.I.G. Really appreciate your coming on, and thanks so much for your time.